Hey everybody, welcome back to Investing with Wesley. In my last episode, I explained to you why you should get a high yield savings account. And in this video, I'm going to do the exact opposite and explain to you why you should not get a high yield savings account. Let's get into it. Well, for starters, let's talk about the main problem with a high yield savings account. The main problem with a high yield savings account is inflation. And inflation isn't localized to savings accounts or CDs or money market accounts or anything. Inflation is universal. But the biggest issue with a money market account is that it doesn't beat inflation. So it doesn't matter how much money you put into these accounts. Over time, inflation will slowly erode at the value of your account until whatever money you do have in there will eventually be worthless. The average long-term rate of inflation is anywhere from 2 to 3%. But the average interest rate on all these different financial vehicles we've been talking about in the last couple of episodes, none of them beat inflation. A regular savings account will get you 0.05%. A high yield savings account will get you 1 full percent. A CD that is penalty free will get you 0.6%, and a money market account will give you 0.5%. As you see, none of these will outpace the rate of inflation, and although some of these accounts are better at holding on to value before inflation robs it of you, not a single one of them actually beats inflation. That's the biggest issue. If you had $10,000 just sitting in a high yield savings account, and let's just say that was your emergency fund or some sort of rainy day fund that you had set aside, and you didn't touch it for 10 years, and then all of a sudden an emergency happened and you needed that money. Well, because of inflation, you would have actually lost $1,000 to $2,000 worth of value in that account. Now, I say value and not balance because although your account will actually grow in value and be worth, let's just say $11,000, the price of everything else around you has gone up due to inflation at an exponential rate compared to the amount of growth you've seen in this account. So although you'll see a balance of $11,000 or maybe even $12,000, it'll only be worth about $8,000 or $9,000 worth of spending because the price of everything else is so high. The bummer here is that although your money is safe, it's guaranteed, and it's extremely liquid in these savings accounts, the longer you hold on to this cash in this account, the less it's worth over time. So the $10,000 you initially deposited into this account all year long will be worth $10,000. But the following year, it'll be worth 1% less. And same with the year after that. And after that, the longer you hold on to your cash in this account because of inflation, the less valuable it gets. So how do we fix this problem? How do we have a safe, liquid account that beats inflation? Well, let me explain to you how. Now, if beating inflation is more important than complete liquidity of your account, investing is the solution for you. Now, obviously, we want something safe and we want something that is not volatile whatsoever because this is not an investment to grow your wealth. This is an investment to store your value. The ETF USMV is a perfect example of the goals that we're trying to get in this investment. USMV is an extremely large ETF and it's largely traded, meaning it's easy to buy and sell when you need to, and your money is not trapped in low volume investments. Now, don't confuse volume with volatility. Volume means how frequently people are buying and selling this particular stock or ETF, whereas volatility is how often the price goes up or down of a particular stock or ETF. So we want something that has extremely low volatility, but extremely high trading volume, both of which USMV has. And just as a cherry on top, they also pay a dividend, meaning whatever stocks this ETF is comprised of are probably going to be blue chip, large established companies that also pay a dividend. So we have large, safe, established companies that pay a dividend as well as low volatility and high volume. This is probably one of the perfect options for you if you wanted to invest to outpace inflation to store your value, as opposed to put it inside of something like a money market account or high yield savings account. Now, the average performance of this fund is about 10% a year, totally outpacing the rate of inflation. And the dividend rate is about 1.7%. If you reinvested all gains and all dividends, then after the same 10-year period where in the other savings accounts you actually lost value, you would actually increase the value of your account in this particular example. If you put $10,000 in this particular ETF and then just waited 10 years before you needed the money, the value in your account would actually be $28,000. So not only did you hold on to the value that you started with, but you also gained a little bit more on the end. With this investment strategy, you can grow your emergency fund or rainy day fund as well as beat inflation. The only drawback is that your money is not 100% liquid like it is in a high yield savings account. In a high yield savings account, you can withdraw your money and it be in your account the very next day. With these kind of investments, there is always a cool off period of usually 2 or 3 days. meaning you have to sell your investment and wait 2 or 3 days before you can actually transfer that money into your account. Now, I know this is supposed to be a liquid emergency fund, but me personally, I'm not worried about a 2 or 3 day delay, especially when I could put something on my credit card, wait 3 days, and then use the money from my investment or emergency fund to pay that credit card off in full. So using this investment strategy coupled with a line of credit or credit card of some kind, if you really need the money in that exact instant, really beats the high yield savings account, money market, or even CD options out there, because it beats inflation, gives you a little bit of growth on the back end, pays a dividend, and is still extremely liquid because it's a high volume traded ETF. Now let's just say you did not like to invest your money, you did not want to invest your money whatsoever in this particular fashion. You wanted your money to stay 110% liquid. What could you do? Well, really the only way to beat inflation and remain 110% liquid is using other currencies compared to the US dollar and their exchange rates. Not every country's currency experiences the same 2% inflation that the US does annually. So if instead you opened up, let's say, a PayPal account where you can exchange things digitally at an instant, you could store all of your value inside the euro, the British pound, or any other currency that you do your research on that has extremely low inflation rate. So although the value of your account in that particular currency will still be subject to that country or that currency's inflation, as long as you pick a stable currency that has less inflation than the United States dollar, you'll beat inflation in the long run just by holding your money in a different currency. Me personally, I think the investment idea is probably the best way to go about it and will remain the best way about it until the Federal Reserve raises their interest rates really high. We're talking the federal funds rate has to go more than 5% in order for money markets to even compete with this strategy. I hope you got value from this video. If you did, please remember to like and subscribe because it really helps the YouTube algorithm get this channel out there so I can help educate more people on the very important topic of finance. I also have a dedicated Instagram account. I don't post there too often, but if you ever had a question, comment, or wanted something addressed, it's a lot easier to reach me there than it would be to reach me somewhere here in the YouTube comments. Either way though, the choice is yours, and I'll see you in the next episode.